The JSE performed very well this week, hitting a record high of 80,791 points on Friday. This results to year-to-date gains of approximately 11%. The top 40 index rose 0.38%. Behind all these numbers, there should be reasons that led to the good performance of our stock exchange. Part of these reasons will be discussed in our global market coverage, but let us first look at the performance of the South African market. On Thursday, the South African Reserve Bank raised the repo rate by 25 basis points to 7.25%. Economists' opinions were divided between an increase of 50 or 25 basis points before the announcement. The Reserve Bank, together with other reserve banks around the world, have been raising interest rates to fight inflation. Even though the prices of items such as fuel have been going down, some economists believe that another 25 basis points increase is still a possibility. This indicates that we might be nearing the top of the hikes. It is then important for a freelance investor to understand the relationship between interest rates and inflation. If interest rates continue to rise, it can sink consumer confidence, decrease employment rate, and lower wages and cause stock prices to fall. If reserve banks go too far and too fast with the hikes, it can result in a recession. To understand the relationship between the two, a person needs to first understand how interest rates work. If you borrow money, you will have to pay extra as compensation to the lender for the borrowing. If you make a loan, you'd want the interest rate to be as low as possible so that you don't have to pay back a lot of money. However, if you are saving money, you might want the interest rate to be a little bit high so that you get more from your savings. This is an interesting point for people who do not take many risks when it comes to their money. Interest rates are controlled by the Reserve Bank. You can take the Reserve Bank as a bank of the banks. Banks, the one we know and deal with on a daily basis. Its primary objective is to protect the value of the currency in the interest of balanced and sustainable economic growth in the Republic of South Africa. This includes controlling inflation, that is, how fast prices rise. To control inflation, reserve banks use interest rates as a tool. If inflation is too high, banks raise interest rates. This change will then spread through the financial system and slow down the inflation rate. How? An increase in interest rates from the central bank means that commercial banks earn more from their reserves. They might make more from keeping their money in the central bank than lending it out. However, if they lend it out, they will raise their interest rates to make it count. Remember, the Reserve Bank is basically a bank of the banks. The impact on consumers will depend on the status of the economy. A higher rate means less cash in the economy, and less cash means less spending, putting pressure on businesses not to raise prices. This then lowers inflation. Such a principle still applies to businesses. When interest rates rise, businesses find it hard to borrow money and invest. This generally means less economic activity, resulting to fewer jobs being created. Fewer jobs and lower wages could mean less money for households. This then again negatively affects consumer confidence. However, the Reserve Bank should be mindful of how far they can raise interest rates. If inflation stays high for too long, things will become too expensive. If things are expensive, employees will need more income to meet their basic needs. And in turn, businesses raise prices as it becomes too expensive for them to operate. This then leads to an upward spiral of wages and prices. Raising interest rates does not immediately result in inflation being reduced. It takes time. And this is where the problem lies. So central banks, when raising interest rates, need to predict what's ahead and raise interest rates with caution. This is why we saw an increase of 25 basis points instead of 50. This is good news. It shows that at this moment, there is reason to believe that we are on the right track when it comes to reducing inflation. The South African Reserve Bank also reported on its forecast of the country's economic growth. I want you to remember what we discussed about inflation and interest rates. How raising interest rates affect the economy. Raising interest rates mean less economic activity, resulting in less economic growth. Now, it would have been easy if things were just as basic as we are explaining them. But some areas are a bit dark at times, especially when you live in South Africa. The South African Reserve Bank slashed the country's economic growth forecast by half for the next 2 years on Thursday last week. The central bank now projects that GDP will grow by 0.3% instead of 0.6% in 2023 as previously estimated. This is due to a whole different level of load shedding we have never seen before as a country. 2024's GDP growth is now estimated at 0.7%, revised from 1.4%. However, an interesting point to look at on the announcement is that the central bank did not seem to have a positive outlook when it comes to alternative energy. As businesses continue to give trading updates, it is evident that load shedding has been one of the serious issues that they had to deal with. Load shedding is somehow the new COVID. If the numbers didn't come out as expected, load shedding might be the cause, or the always naughty child that ends up taking the blame. Nonetheless, South Africans and its businesses need to come up with alternative energy supplies to survive. And that might slightly contribute to the country's economic growth. Now, let's look at how some companies performed. The Foschini Group released its Q3 trading update on Monday. The group reported a turnover growth of 5.7% in the quarter to end of December compared to the previous year. Black Friday and Cyber Monday in South Africa delivered a turnover of more than 1 billion rands on those 2 days. Strong growth in clothing sales was supported by its South African clothing supply chain, the group said. The group's profit margin is 1% lower compared to the previous year because of increased costs due to load shedding. SASOL also released its sales and production update for the 6 months ended 31 December 2022 with a little bit more to it. The company signed 3 new power purchase agreements for renewable energy in its South African operations. Per the group, it is committed to reduce its greenhouse gas emission from its South African operations by at least 30% by 2030. SASOL's production and sales reports reflected a positive outlook for the company, despite the negative impact of weaker global economic growth. According to the company, its chemicals business continued to face challenging market conditions, including the macroeconomic environment downturn, inflationary pressures, COVID-19 impacts in China, and sustained higher energy prices in Europe. The company's production was impacted by China's COVID lockdown restrictions and supply chain disruptions. As a result, sales revenue was 2% lower compared to previous year, and sales volumes were 5% lower compared to prior year. Truworths also released a business update and voluntary trading statement for the 26-week period ended 1st of January 2023. As a result, the company's share price was up by 4.17% on Thursday. The group forecast half-year profit growth of up to 11% due to Black Friday sales. Group retail sales increased by 13.7% to 11.3 billion rand. Truworths said that 77% of its South African business turnover was covered from load shedding. Nonetheless, load shedding is likely to have a negative impact on retail footfall and consequently on retail sales, especially in malls without backup power, the group said. The US economy finished 2022 in solid shape even as questions persist over whether growth will turn negative in the year ahead. Fourth quarter gross domestic product, the sum of all goods and services produced for the October to December period, rose at a 2.9% annualized pace. Some economists had expected a reading of 2.8%. The growth rate was slightly lower than the 3.2% pace in the third quarter. The US is projected to hike interest rates by 50 basis points in 2023 before pausing as indicators show that inflation is cooling off. The JSE ended higher on Friday as global sentiment improved, rounding off another successful week during which the all-share index hit a series of record levels. The South African share market has taken its cue from the global trends, particularly China, where the government dropped its zero-COVID policy earlier this month, triggering a surge in market optimism as forward-looking investors bet on its economic recovery. China has increasingly become a proxy for the South African market because of its important role in consumption of commodities that the country produces. China is also home to tech giant Tencent, in which South African company Naspers owns a 20% stake worth more than 2.03 trillion rands. I am Billy, and this brings us to the end of our episode 2 of This Week in Markets. All thanks to Zoe and the team. We'll meet you again next week.